Have you ever had a period of time when it seemed you could do no wrong in your trading? Every time you bought, the market moved up, or every time you sold, the market moved down. Quite often, you'll see that contest winners will have incredible returns in a short period of time, but just as often, you will see them give most or all of the gains back just as quickly. Many will attribute this winning period to blind luck, and there is some truth to that. But a small number of traders understand why this happens and look to find those situations to repeatedly take advantage of. Now, what do they look for? Simply put, they look for the trend of the market. This may be the most overlooked but yet most important part of identifying a trade. If a market is moving up strongly, sometimes it doesn't matter what strategy you use to time your buys, you simply need to be buying. If a market is moving down strongly, then you just need to be selling at times. When you trade in the direction of the trend, the rest of your trading approach can fall right into place. Now, this doesn't mean that all your trades will be winners, but it does mean that you don't have to be exact in your entries and exits to give yourself a chance to be profitable. The idea is to find the most obvious trending moves you can find and look for trades in those environments. So the first step we should take when looking for a trade is to determine the trend of the market. This step will determine our trading bias. If the market is in an uptrend, we only want to be looking for buying opportunities. If the market is in a downtrend, then we only want to be looking for selling opportunities. If the market is range bound, we want to buy just above the lows or the support level and sell just below the highs or the resistance level. Now, if you're unsure of the trend, then we should pass on the currency pair and find another where the trend is obvious. There are more than 3 dozen currency pairs available to trade, and we should only look for the best trade setups. Here's a simple but effective way to identify the trend of the market. An uptrend is where a market makes a series of higher highs and higher lows. And an uptrend changes to a downtrend when the market trades through the previous low. A downtrend is where a market makes a series of lower highs and lower lows. And a downtrend changes to an uptrend when the market trades through the previous high. A range-bound market is where trading is limited to between 2 similar price levels. These are our 3 major market conditions: an uptrend, a downtrend, and a range-bound market. And as you can see, recognizing each of these market conditions can be fairly easy, and you can use that to your advantage in your trading. Now, it's important to note that there are no specific rules for identifying high and lows to use for trend analysis. The idea is to pick the most obvious examples of an uptrend or a downtrend or a range-bound market. If you're not sure of the trend, then move on to the next pair where the identification is easier. Take advantage of the fact that there are many pairs to trade. This is one of the advantages of trading the FX markets. Now, let's take a look at some good examples of strong trending moves in different currency pairs and different time frames. Here's a good example of a strong trending move down on a daily chart. Now, I like to use about 6 months of activity on the daily chart to get a good feel for the mood of the market. Here I see a downtrend as a series of lower highs and lower lows as noted on the chart. This is a good environment to be looking for selling opportunities because of this situation. Here's a good example of an uptrend on the 4-hour chart. I like to see at least 20 days of activity on the 4-hour chart. Here I can see an uptrend as a series of higher highs and higher lows. And this is a good environment to look for buying opportunities, as you can see where each time the market moved down, it found support and moved back up to the new highs. The idea is not to try to convince yourself of the direction of the trend, but to pick the pairs where anybody would be able to identify the trend. If you were to ask a 10-year-old boy whether they see the lines moving up or down, or if they weren't sure, they'd answer honestly. And we need to do the same. We need to keep it simple, keep it consistent, and be very picky about what pair you choose to trade. Now, here's one more example on an hourly chart. On an hourly chart, I like to see at least 5 days of activity. While we always recommend that traders only trade in the direction of the trend, sometimes new traders get caught up into looking at a small period of time without getting a real good feel for the mood of the market. This would be like watching a team sporting event and only following a couple of the players instead of the entire team. Sometimes to really understand what is happening, we need to take a step back to see the big picture. For example, take a look at this 15-minute euro-dollar chart. There's a nice strong move down, and right here there's a pullback up to the resistance line. This is a classic selling opportunity. Or is it? Now let's take a step back and see what's really going on with the euro-dollar pair. If we look at a daily chart, that strong downtrend we just described really looks like a very strong uptrend. Right here, this is the downtrend we were looking at, and although the pair did move down for some time, you can clearly see that it quickly ran out of steam, reversed course, and continued on its long-term upward trajectory. So our goal is not to get caught on the wrong side of the trade. Now, how we do that is to analyze more than one time frame when you're locating trading opportunities. We recommend looking at a longer time frame chart to determine the trend, and then move down to the smaller time frame chart to find a trade in the direction of the longer term time frame. We want to choose time frames that offer some continuity on a trending move, but not so close that we're looking at the same activity. We recommend using between a 4-to-1 and 6-to-1 ratio of time frame. As examples, consider the following. If you're trading on a daily chart, use the weekly chart to identify the trend. If you trade on the 4-hour chart, use the daily chart to identify the trend. If you trade on an hourly chart, use the 4-hour chart to find the trend. If you trade on a 15-minute chart, use the hourly chart to find the trend. For a 5-minute chart, use a 30-minute chart to identify the trend. And if you're trading on a 1-minute chart, use a 5-minute chart to first identify the trend. Now remember, the shorter the time frame combinations, these will offer the most trading opportunities, but we believe that the longer time frame combinations will offer the better trading opportunities because of more accurate technical analysis. The reason is sampling. There are just more trades in a candle on the daily chart than there is on a candle in a 1-minute chart. This means that the longer time frame charts are just a better representation of the real mood of the market, as they include more opinions on market direction in the way of trades. The more opinions you have, the better the representation of the majority of traders. But each individual trader has to take into account the amount of time they have to commit to the market and personal preference on the style of trading they're comfortable with. So everyone will approach things a little bit differently. Now to close this video, let's quickly recap what we've covered. First, the goal is to identify the mood of the market. Is the market in an uptrend, a downtrend, or range bound? Next, make sure to identify the trend of the market with a longer time frame than the time frame you'll be trading with. And finally, always try to place trades in the direction of the larger trend. Now, this concludes our brief introduction on trading with the trend and using multiple time frames. To learn more, make sure to watch our Part 2 video as well. Thanks for watching and good luck with your trading.